Hello, everybody, and welcome to Derisk Ethereum Staking, a guide to on-chain cover. We'll go ahead and do quick intros. My name's Chris. I work at Figment, do production and marketing with a focus on video. Josh is also at Figment. Would you like to introduce yourself, Josh?
Yeah, sure thing. So I've been working in the blockchain space for about 5 years, started my career at KPMG where I was owning blockchain type clients, then transitioned to manager of financial planning and analysis at Bitfarms, which is one of the larger Bitcoin mining companies in North America. And then I have since, for the last a little more than 2 years, been at Figment, where I am basically a product manager that is focusing on risk, staking type risk in particular, the coverage that we offer our customers, as well as the insurance that we can secure as a business, including on-chain cover, which is why we're on this call with you.
And Hugh, would you like to introduce yourself?
Yeah, hey everyone. Hugh Cupp, I'm the founder of Nexus Mutual. I'm an actuary by background, so a lot of experience in the traditional insurance industry before kind of getting into crypto. Worked for various insurance and reinsurance companies in Australia and the UK. So yeah, got a deep history on that side, and got into crypto relatively early on and was fascinated by the whole thing and decided to make the leap and recreate the mutual on chain. So yeah, a lot of background in the risk side of things, and kind of a personal interest in crypto has kind of led me to where I was today.
Awesome. Now that we know who's going to be speaking, let's kind of just go over the agenda here. We'll be talking about staking risks on Ethereum, followed by the history of penalties incurred to date, staking provider risk management, traditional off-chain insurance, and on-chain coverage in Nexus Mutual. Without further ado, Josh, would you like to take it away?
Yeah, sure thing. It's the talking heads portion of the presentation. If anyone has questions along the way, like Chris mentioned, feel free to shoot them through. But in the meantime, we'll just drop some knowledge bombs. So first and foremost, the main intention of the presentation is to demonstrate how Figment is truly offering 100% coverage for customers, for Ethereum customers in particular, for double sign slashing. Once in a while, we'll hear that some other staking providers claim to offer 100%, but they don't have off-chain insurance. They don't have on-chain insurance partnerships, basically meaning that they're relying on their own balance sheets to cover for this type of risk. And as you'll see throughout this presentation, that's not really feasible at scale to rely solely on your balance sheet. So we really, truly are getting there to the full 100% coverage with the partnership with Nexus Mutual. So before diving into kind of the actual numbers and figures, I think it's important to all align on the definitions of what risks are for those who stake on Ethereum. So some of these are a little bit simplified. For example, downtime penalties is used to basically describe when a validator is not participating in the consensus process. So whether this be technical difficulties or just not having internet connection and not being able to participate, you basically receive small slashing penalties for not fulfilling your duties. In contrast, there's something called double sign slashing. So this is when there's two instances of the same validator that are up and running. You sign two blocks at the same block height, and you're effectively creating a fork in the network, which is considered an attack on the network. It's harder to achieve consensus, and that's where you have a more significant slashing penalty. What's unique about Ethereum and a couple other networks like Polkadot is there's something called correlated slashing, which basically means the higher the number of validators affected by this double sign event, the more material the penalty becomes. So this is something we'll reiterate throughout the presentation, but it's important to keep that in mind as to why Ethereum is considered one of the more risky networks and why it's important to get coverage like we'll be describing with Nexus Mutual. Lastly, there's misrewards. So misrewards, similar to the downtime, is when you are offline. There is no actual impact on your underlying principal or the amount that you've staked, but you're basically not earning rewards that you would have earned had the validator been up and running effectively. So now that we've talked about kind of the definitions, I want to talk about what the theoretical penalty scenarios are. It's important to kind of understand what the breadth of loss could look like when it comes to staking. So what we've done is we look at a single validator. What happens if a validator is down for an hour versus 24 hours? So in the situation here, you'll see that downtime is roughly for 1 hour is about 15 cents of loss. For 24 hours, which doesn't happen all that often, it's never happened at Figment. If you're down for 24 hours, you're looking at about $3.50. In contrast, there's something called an activity leak that exists on Ethereum, which is what happens similar to the correlated penalties that I described before. If ever there is more than a third of the active set that's down at the exact same time, there are higher penalties. But if you look at the more extreme scenario here, 24 hours of downtime, you're looking at about $80 US of loss for being down for 24 hours in this more extreme and unlikely inactivity leak scenario. If I contrast that to double sign slashing scenarios, you'll see losses far greater. So in an uncorrelated event, which basically means less than 1% of the active set is slashed in a single event, you're looking at about 1.07 ETH of loss, which is about $2,000 at today's price. And that scales, the correlated component that I mentioned before, will increase the penalty as more validators are affected in the same event. So for example, if 1% of the active set, which is about 7,000 validators, are double signed slashed in the same basically 36-day window, penalties become 2.03 ETH per validator. And if 10% of the active set is double signed slashed in the same event, you're looking at more about 10 ETH, 10.5 ETH of loss for a single validator. So what you can see here is the difference between the more significant double sign event and the difference between downtime being far less material. Once in a while, we will get a customer that asks Figment, can we have an uptime guarantee? And one of the things that I like to explain here is that it actually, there's a disincentive here for why you should not look for an uptime guarantee, because the downtime penalty is so immaterial in comparison to double sign event. What you should be doing as a delegator is to come to Figment and say, what do you do to reduce the likelihood of a double sign slashing event? That is by far the most important consideration that a staking provider as well as stakers should be thinking about. So again, optimizing for uptime is not the right strategy in our opinion. It really should be reducing the likelihood and magnitude of double sign loss. So now that we've talked about kind of the theoretical side, so we talked about the possibilities of loss at different scales, what I'd like to do is look at the on-chain data and see, well, what has truly happened to date, because that's a better representation of what loss can look like for you as a delegator. So Figment indexes its own on-chain data. So this is us putting together dashboards that we use to actually actively monitor the Ethereum network to make sure, has there been double sign events, has Figment been affected, etc. So the key takeaways here, if you look at the top chart, is that Figment has never had a double sign slashing event in its history, not just on Ethereum, on any network. In contrast, there's been 261 total double sign events on the Ethereum network since the beacon chain. So the key takeaway in this graph that you'd see is that if you look at the highest blue column there, basically the orange line represents the amount of loss in ETH terms, and the blue column represents the number of validators affected in that slashing event. What you'll notice is that the highest number of validators ever affected in the same slashing event is 93. So we talked before about correlated slashing and that you would need 1% of the active set to be slashed for there to be a correlated penalty. That would mean 7,000 validators. So in reality, we've come nowhere close to a correlated event, which is why protecting for an uncorrelated event really is the main, the primary consideration that you should be worried about. So in total, once in a while there's a customer that will also bring up, what happens if I come and I stake and I lose everything? And it's just extraordinarily unlikely. It would basically require about 30% of the active set to be double sign slashed at the same time, which is about 2,100 validators, far from the 93 that we've seen in the max scenario. In fact, the total amount of loss ever due to double sign slashing is a little over 80 ETH. At the time of the event, that's about $126,000. So we haven't seen a ton of loss, although that doesn't mean that you shouldn't protect against it. Similarly, if there's no fires locally where you live, do you still get insurance for your house in case of fires? Yes, you would still get it in case of the unlikely scenario where it occurs. Similarly here, we feel that it's important to protect yourself, even though the likelihood is low. And Figment has never had double sign slashing. The chart, the little table at the bottom, what that's basically doing is just to show you what I do on an active basis to monitor the network, basically. So here it shows what validators have been double sign slashed, how much have they been slashed for, and in the far right column, you'll see, is it a Figment validator, yes or no? never seen a yes, but in a case that we would, if DevOps hasn't already identified the double sign slashing, we would investigate as quickly as possible and make sure that no more validators are affected by the event. So the 1.07 ETH of loss really is what we'll be focusing on here in this conversation. Hugh will get into the specifics about the on-chain coverage in a bit, but really that's the amount that we're looking to target to cover at 100% is that 1.07 ETH of double sign slashing that is uncorrelated. And then the last thing I'll mention on this slide is that even in the case of the 93 validators being slashed, that was only a subset, a very small subset of the validators that staking provider was operating. So in general, it's not an all or nothing. It's not, you have no validator slashed or all of them. In general, it's only a small subset. It's also something to keep in mind. So all of this kind of explains why Figment operates what we call a safety over liveness principle, which basically means that we will do everything in our power to reduce the likelihood and magnitude of double sign slashing events, even if it means incurring some downtime. So as you'll see before, the amount of downtime penalties is so small that we would rather incur a little bit of that just to ensure that we don't have any double sign events. So I want to talk about, let's see this question. How do you reduce double sign slashing risk in the first place? Great question. And then that's exactly what the purpose of this slide is. So staking providers, risk management is like the #1 consideration for staking providers. Yes, rewards are important, but reducing the likelihood of a principal loss really is a #1 priority. So there are layers of controls in place to reduce the possibility of a double sign event occurring in the first place. So when you look at my fancy Swiss cheese model here, you'll see that there's different layers of coverage. So first and foremost is what we call deterministic key distribution. This basically means that when we spin up a new validator, it gets allocated to validator cluster, and there's no way that validator can get spun up on a second cluster. It basically ensures first and foremost that there is no way of having 2 instances of the same validator up and running. But there's a second, redundant control. We call it the local anti-slashing database. And what that basically is that anytime a validator is looking to sign the transaction, whether it be an attestation or proposal, it will check its own database to make sure that it itself hasn't asked for that signature already. So it's a control checking itself. Let's say that's defective. What the next layer of controls is a remote signer. So in the case of the validators operating, they will basically they don't have access to the keys. What they are doing is they will ask the remote signer to sign a transaction. That remote signer is an independent database that will look at all the transactions it's being asked to sign, and it will double check that there has been no duplicate asks for a signature. And then if it sees that there is no duplicate ask, that's when the attestation or proposal will be signed. And then lastly, the fourth layer that's kind of all encompassing is Figment has Figment is SOC 2 Type 1, ISO 27001 certified, working on its SOC 2 Type 2 certification that's in progress. All of this has to do with the operational controls at Figment. So Figment has a large security and DevOps team that's actively monitoring any type of activity that has to do with access to the validators or keys. There's very restricted access, and all of these have to do with controls that exist in the SOC. There's also the on-chain validator monitoring that I mentioned before. This is kind of a last ditch effort, is me monitoring on-chain activity to see if anything has fallen through the cracks based on penalties that may have occurred at Figment. So all of these are examples of ways to reduce the likelihood of a double sign event occurring. And then on top of that, there's also ways to reduce the magnitude of loss. So examples would be you have diversity of cloud infrastructure or diversity of location of geographies. You have diversity of the client software that you're operating your validators on. Those are ways that you can basically make sure that, let's say there's downtime that occurs in North America, but if you have cloud diversity or if you have a geodiversity in a different area, you'll still have uptime there. Similarly, if there's an issue with the Prism validator client, if you're operating on Prism and Lighthouse, at least it's not affecting all of your clients. So these are things that Figment is actively doing as well. So in general, we look to reduce the possibility, but also magnitude of loss. So Figment in general, like many service companies, offers coverage to customers based on a certain number of months of fees collected from the customer. The reality is that if you were to do the actual math, the fees collected don't always add up to covering the entirety of the penalties incurred, which is why it's so important to have insurance and on-chain coverage. The reason why insurance, traditional insurance, is important for a staking provider to get is the more insurance a staking provider has, the more coverage it can offer its customers. And then there's on-chain insurance being extraordinarily complementary, where customers are able to purchase on-chain cover directly themselves to further protect themselves. So the difference between traditional and off-chain insurance, and then the on-chain is where I'm going to wrap up here before handing it off to Hugh. So historically, the traditional insurance policies were okay, and they have had a lot of room. They had a lot of improvement this past year. Figment's worked very close with Aon, and I think this is something that we'll have a future webinar on. But we really moved the space forward in providing a policy form that's much more applicable and relevant for staking providers. That being said, there are still downsides to these traditional traditional off-chain insurance policies. For example, they indemnify the staking provider, being Figment, and not the end customer. They have a relatively high deductible, meaning that they're focused on the more catastrophic scenario of the correlated type events. And there may be delays in payments just because of the process of traditional insurance companies of reviewing claims, etc. And it's also costly to scale. You have a certain amount of capacity in these policies. If you want an extra X millions of dollars, it's going to cost quite a bit to get that additional coverage. In contrast, on-chain coverage like Nexus Mutual covers the more likely loss scenario. So it's focused on the 1.07 ETH of loss, the uncorrelated event that we discussed. There's low or no deductible. In the case of this policy, as Hugh will discuss, there is no deductible. There's no minimum number of validators required to be covered. The delegators will be indemnified directly, as they are the ones purchasing the coverage from Nexus Mutual. And there's a very fast turnaround time. Hugh, you can correct me if I'm wrong, but I believe it's 2 days. Maybe it's a little bit longer, but still it's going to be significantly less than the traditional insurance claim. So without further ado, I'm happy to hand it off to Hugh, who will go into more specifics about what is Nexus Mutual and the Nexus Mutual offering.
Cool, thanks, George. There's a few questions in the chat that I'll kind of address along the way as well. In terms of like historical pricing, why would you need coverage if there's not been many slashing events and that type of thing? But I'll just kick it off with like a bit about Nexus. So we are a insurance alternative. We're built on Ethereum, essentially a club or a mutual where members come together and they share risk amongst themselves, primarily focused on crypto risks such as smart contract coverage and slashing coverage more recently. So I think in general, mutuals are this very, very old thing. They're owned by their members. So we're not actually doing anything really new here. What we're actually doing is just automating something that's extremely old. So it's a very old structure. It fits very natively within blockchain because it's like member owned and driven and all that type of thing. So I think it's a really good spot to develop the new way of doing insurance. So that's just, I guess, a bit of background. I think more generally, the insurance industry has a very strong history of communities banding together to cover new risks and protect each other, like shipping hundreds of years ago and all the rest of it. And if we're developing this new economy in crypto, and slashing and staking is a big part of that, then I think the communities coming up with their own policies and their own structures makes a lot of sense. So that's just generally very high level about Nexus. So in terms of just some key stats, Josh, if you could just jump to the next slide for me. There's just some key things. We have about 270 million of assets in the capital pool. It's fully transparent. You can go and see that on chain. We've paid nearly 18 million of claims across a whole bunch of different loss events. One of the more recent ones being FTX. We may also pay some claims as a result of the Curve hack on Sunday. So we'll see how that goes. Waiting to see what happens there. But the point being, we're established, lots of people are buying cover, and we've got all the assets, and you can dive into the details, which are fully transparent. So we've been doing this for a while, since 2019. To kind of get into the risks on slashing and staking more generally, as Josh has kind of like pretty much alluded to, gone through some of this detail, we kind of, from our perspective, we kind of classify things into three major buckets. There's the slashing, which which is primarily what the focus has been here. That's the primary risk you really need to be concerned about from a delegator or a staker point of view. It's this balance between it's relatively unlikely, but the impact is high. Downtime, I guess it's quite likely, but the impact is really low, and it's more about managing it and making sure that it doesn't get out of control. But it's nothing really to worry about too much. And then you've kind of got this other bucket, which is kind of the black swan network failure possibility, which is independent from Figment. It could happen more at the client level or network level. And effectively, any ETH holder is kind of effectively exposed to this anyway, because if it was to happen, you'd expect the ETH price to tank. And so Nexus and other insurers can't really provide coverage for this, but it's worth noting for kind of full disclosure purposes. And I think the main point here is that if you're already in ETH and you're holding ETH and you're looking to stake it, the primary risk you should be concerned about is the slashing side of things. And I would really echo Josh's comments on the over optimization of downtime. It's so easy to fall into the trap of creating automatic fallover systems and all the rest of it that kind of kick in when there's when it's registering that a validator is offline or something. But that means you hold the keys on two different places. And what happens if the first one comes back up and then all of a sudden you're double signing and you end up slashing? And that's effectively what happened when one of the staking operators ended up with those 93 validators slashed. They were trying to over optimize on the downtime, and it really is a false economy, and we've seen it. And like, if something happens in the middle of the night and you're an operator, you don't want to be rush changing anything to upgrade. You'd much rather take a few hours of downtime, get out of bed, wake up, have your coffee, make sure that you understand what the situation is, and slowly roll out the change and do it properly. And so really over optimizing that downtime just doesn't make any sense. And the good operators we've seen don't focus on that downtime. They obviously want to have reasonable downtime and all the rest of it from that point of view, but over optimization and automatic fallovers is when you can get yourself into a lot of trouble. So I think that's one thing to be aware of. In terms of like history, and there hasn't been very big slashing events, so what are we really worried about? I think the first one is the beacon chain hasn't been live for that long, really. Like insurance pricing, you do, like I'm a life insurance actuary. you price insurance and mortality rates over hundreds of years. With the beacon chains being there for less than 2 or something. So like it was just in a totally different scenario here. We haven't got that much experience. I'd also note that the technology and the support technology around these systems, like the safety stuff, like a whole bunch of those items that Josh was mentioning in his Swiss cheese type model are kind of just being developed, or relatively new, and more of those types of things are rolling out. And so I think we're still in that new stage. And one of the other points is you can have all of these fantastic barriers and prevention measures, but every now and then you're going to have to upgrade things. And how do you roll out that upgrade, and how do you do it properly? And there's always risk at change points. And the Ethereum network can also upgrade, and then that requires the operators to do something else. So I think we can always say, oh, it's nothing we should worry about. Fine, hopefully that's the case. But there is always a chance that something could happen. So definitely focus on the slashing risk and be aware of the downtime. And I'd be skeptical of people that are overly focused on optimizing downtime. To me, it's a bit of a red flag. But that's the main point from the risks point of view. Josh, if you want to go on to the next few slides, I'll just kind of quickly run you through the process for buying some slashing cover with Nexus. It's really quite simple. Hopefully you can see some of the slides here. They may be a bit fuzzy, but you can come back to them and blow them up a bit later if you can't. But essentially, go to the Figment buy cover page on our site, enter how long you want the coverage for. You'll have to upload the only relatively complicated part, but it's not that complicated, is just upload a file which contains the validator numbers that you're validating with Figment, and we can work that out easily between Figment and ourselves. And then you'll get the price and simply buy cover from there. So Josh, if you just want to flick through to the next few slides. There's obviously just have a quick look at the terms and conditions. The full details are there. It's fully transparent. And then you get the quote on the price and click by cover. And then once you've done that on your Nexus cover or your member page, it'll show you your coverage details, how long you've got left, etc. And if you need to claim, just hit the claim button and go from there. On the claim side, it basically takes 3 days to vote and for the payout to come through. So it's very quick once you've provided the details, much quicker and easier than regular traditional insurance, I guess. I guess like a very high level advantages of the on-chain cover. We've got a discretionary mutual model, which that means it's a tried and tested model. These things exist for hundreds of years. It's based on community overheads, and it means the members decide on the claim payments. Here, we've structured this particular coverage to be very like parametric, like triggered. If something happens and there is a slashing event, then it's paid. And we can look on chain. There's evidence. You've loaded the validator number. It's very black and white whether something happened or not. So it's very easy. We're fully transparent. You may not have heard in over the last few weeks, Vest2, an insurance company, just blew up because they didn't have 4 billion of assets that they said they had. That can't really happen with Nexus. You can see it all on chain. It's all there. So perfect transparency into everything that we're doing. Yeah, we've paid 17 odd million of claims so far, more than any other on-chain provider. And one of the more important points versus traditional coverage is you actually denominate the cover in ETH. So if ETH goes up 5 times, you don't have to buy a top-up policy because you bought it in US dollar terms. It's in ETH terms. You buy ETH, the coverage, and that's it. So it's all linked. There's no basis risk anywhere. So I guess those are the major points. Happy to go through and actually one last slide. I forgot. Thank you. Some people ask, who are the underwriters? Who are the people deciding behind this and things like that? The key underwriters for our slashing product are members of the core team, including myself. We've got deep experience within crypto and got actuarial knowledge. We've kind of done this stuff and doing new products for crypto for quite a while now. We also have a growing underwriting ecosystem where any other members of the mutual can come in and launch products and do pricing, and we're expecting other experts to come in and also offer some slashing coverage capacity as required. But for now, it's primarily driven by the core team members, and from there, so they're the key underwriters on this product for now. So yeah, hand back over to you, Josh.
Yeah, sure. So great. Thank you, Hugh. I think it's a great opportunity now to kind of go through some of the questions that we have in the chat. I'm just going to open up the Q&A section. Just going to scroll up to the initial question. So Alex had asked, how do you gauge the risks associated with slashing in terms of A, the likelihood of it transpiring, and B, the potential magnitude of the slashing? If we're to rely on historical data, it would appear that insurance doesn't quite add up from a commercial perspective. Historically, there haven't been any notable slashing events. Moreover, based on this past data, the cost of insurance doesn't seem to cover the potential losses. So it feels like we're buying an umbrella for the drought, doesn't it? Okay, good question. So when it comes to, the first part of the question is the likelihood of it transpiring. So this is something that maybe actually Hugh can probably comment on, is like how, from an actuarial perspective, do you look at probabilities of kind of a likely and never happened before scenario? Do you want to address that side, Hugh?
Yeah, I mean, this always happens when you're coming up with new products for new markets. Like, you have some data, and so you can base it off that. But there's also a bunch of events that are very easy to think about or reason about that could happen, but you just know that they haven't actually occurred yet. And so you're in this situation where you don't have the data to do a full pricing, but you've got some things, and there are models and other aspects you can relate to from different industries and stuff about like what's the ratio of those types of things. And look, there is a bit of art to it as well as science, but like it's clear that some of these risks haven't eventuated yet, and hopefully they don't. But there is still a chance that they do happen. And so, obviously up to each individual to make their own call on whether the insurance or coverage is worth it. But I would say that, it's still relatively new. while everyone's taking all due care on all this stuff and doesn't want slashing to occur, obviously, there are still new technology that we're working with, and changes happen and things. So, there are still risks that people need to be aware of.
And I think it's important to note one thing that we haven't discussed is price. So Alex, to kind of address is it worth buying, given the cost? The cost is actually extraordinarily low, which is why I think I'm on this call with Hugh in the first place, is that it's actually affordable coverage for once. And I want to be clear, Figment has no kickback. This is purely just wanting to protect our customers better. We think it's important for the industry altogether. It's important for the staking space. The ideal scenario is that customers can stake risk-free. That is the ideal scenario. And in this situation, you can buy 1 ETH of coverage through Nexus Mutual for the preferred pricing policy that we have. You're buying 1 ETH of coverage, and it's costing you 0.025 ETH per validator. So again, that's 0.025 ETH per validator. In contrast, rewards for a validator in a given year is roughly 1.6 ETH. So you're looking at about 1.5% of your rewards is the cost per validator. So you're still walking away with like 98.5% of your rewards, but now you have 100% coverage. So that's why I'm so excited, and that's why Hugh's excited. That's why we're all excited about this policy, is that it really isn't all that expensive to have a significant higher amount of coverage. So at the end of the day, like Hugh mentioned, it depends on your risk profile. Maybe you don't want to spend the extra 1.5% of rewards on coverage, but the amount of bridged cover you're getting here, in my opinion, really justifies the purchase. So the potential magnitude of slashing, just want to address that part of the question. So what I am constantly doing on a regular basis is I am calculating the total risk exposure that Figment in and of itself represents in the case of a loss. So I'm looking at the likely 1.007 ETH of loss scenario, but what happens in the case where every single one of Figment's validators are affected? So I'm looking at that magnitude and always trying to assess how much more coverage do we need in the traditional insurance sense to make sure that Figment can always honor payouts. But I want to be clear that the way that we structure coverage isn't going in and saying we offer 100%. What we do is we offer a certain number of months of fees collected from the customer, which is basically designed in a way that we can always ensure a payout to all of our customers because it's denominated in fees, in months of fees collected. So hopefully this addresses your question. Ultimately, this allows you to provide up to 100% coverage for only 1.5% of rewards, basically.
And to build off of the price question for you, Hugh, and if you can't answer this, and it's no problem, but how does Nexus Mutual determine the price of cover?
Yeah, I think that's what I was kind of alluding to before, really. So what we've done is we've taken, there's 3 main components to it. There's the actual historic data of what's happened to kind of give us a broad understanding of the risk of slashing. Then we look at Figment's particular setup. We go through basically all the items that that Josh went through. What failover processes do they have? How do they split geographies? How do they do their setups? How they roll out changes? All that type of stuff. We go through the questions. We do deep due diligence on it, and then we've given a Figment specific price based on our view of their setup. So those are the two main things, and then also there's an adjustment. I guess it's kind of going back a step, but it's all kind of that adjustment for the risks that haven't happened yet. And so you kind of pull all that together. And so I guess the first point is from our perspective, Figment are quite strong on all of the key items. Like that, I think that's clear. They're looking at the right things, and I think culturally and approach-wise, they're doing it in the way that we like. That optimizing, not optimizing downtime pieces, I think is actually really key. So that's generally how we price stuff. So it is based off the historical data with some adjustments for specific setups.
And just to kind of go a little deeper on that, we have a question in the Q&A. Customers may have different staking time horizons. Is there flexibility in the term of the coverage?
Yeah, there is. So minimum coverage term is like 30 days, and you can kind of buy longer than that, buy shorter than that, roll it every 30 days, whatever you wish. So a lot more flexible than traditional insurance, which is basically buy for a year or whatever.
Since we're talking price and term, I am curious about how Nexus Mutual determines the policy limit, like the aggregate amount of cover you're willing to allocate to staking cover, for example.
Yeah, I mean, ultimately, it's up to our stakers to back it with capacity. So, we have to have our stakers like open up capacity on new risks if they think are good. And so, kind of that's down to because our core, the staking pool that's driving a lot of this stuff is kind of driven by our core team. And so it's kind of how much we want to release, because we're putting our own money at risk behind this thing. If there's a staking event, we get slashed on our side. So that's kind of how we do it. There's also protocol limits at the Nexus Mutual level, which prevent any individual risk being too much of our total assets. So basically, to make sure we can pay all claims. So we make sure that we've got enough money to honor the claim payments, basically.
I see Alex did have a follow-up question to his previous question. It was just a continuation saying, if Figment's record is clean with no double signing ever, does that mean I can stop worrying about it? If yes, then isn't insurance superfluous? But if I should worry, how do I gauge the risks? So we are very confident in our infrastructure, and this is something we're constantly working on. Not only are we confident, but that's why we go to get certifications like SOC 2 Type 1, SOC 2 Type 2, which basically assesses the design of your controls, and then SOC 2 Type 2 is the actual effectiveness of those controls. So we are basically securing independent evaluations to make sure that we have no gaps in our control environment. There's also ISO 27001 certification. So at the end of the day, we're very confident, but it doesn't necessarily mean it will never happen. There's always upgrades to the networks that could cause something unexpected, a software-related bug. That being said, there's multiple layers of vetting. There's test nets. Figment also upgrades its validators on a batch-by-batch basis, so it's not like we're upgrading everything in one shot. But that being said, that it could always happen. So at the end of the day, it's up to the delegator or the staker to decide whether or not additional coverage is warranted. We're here to basically work out the best possible coverage terms for you. And that's why we are working with Nexus Mutual to come up with the best terms for our customers. And I believe we've done that. But at the end of the day, it is your call if you would like to buy the coverage. And I'll stop there. Alex had a follow-up question. Going through your pricing details, I noticed you mentioned that compensation from each validator could be up to 1 ETH. 1 divided by 32 is 3%. So am I correct in understanding that you're estimating slashing risk and maximum loss to be around 3%? So when I showed you the actual loss scenarios, when I showed you the chart, actually I can just go back. Technically, you could have more loss, and that's if there's a correlated slashing event. So that's what would happen if more than 1% of the active set gets affected. But if you look at historically, only 93 is the maximum number of validators affected, which means basically the percentage of affected validators is in the very, very low decimal places and nowhere close to that 1% threshold. So what we're trying to do here is target the more realistic risk, which is a very small subset of validators are affected, not hitting that 1%. So in that situation, the amount of loss is 1.07 ETH per validator. The Nexus Mutual cover will cover 1 ETH of that. And then Figment has agreements with our customers that basically offers coverage off the shelf, the delta between the amount of loss and the amount of coverage that we offer. If it makes up the remainder of the unpaid amount, that's basically the amount that we'll pay. So all this to say, we are covering near, if not 100% of an uncorrelated event in combination with Nexus Mutual, but there is the possibility of more catastrophic loss. It's not that the policy won't come into effect. Basically, as long as less than 10% of the active set is affected, Nexus Mutual's policy will still pay. It's just the amount of loss is greater in that situation. So you'll still get the 1 ETH from Nexus Mutual, you'll get the off-the-shelf coverage from Figment, but in those more correlated events, there will just be more loss exposure for the delegator. But this is a limitation in the space. This isn't an issue. This isn't like a staking provider issue. This is purely just a lack of coverage being available at scale for these very unlikely scenarios. And in general, from my conversations with traditional insurance companies, It's a lack of capacity. It's a lack of kind of the business case to really scale in the case of hundreds of millions of dollars of loss. So, but we're working towards it, and that's why we work with companies like Nexus Mutual, why we work with Aon from a traditional sense. We're working towards over time building enough capacity to address those more catastrophic events. And I think that will happen. Like if you look at custody type risk, there's very large hundreds of millions of dollar policies. My hope is that eventually we will get to that space. Those types of capacities for staking. And I think in 1 year, 2 years of effort would come a long way. So I think it is feasible. Hugh, did you want to add anything there?
Yeah, I'd just say that like the insurance industry does come along to these things, but they're risk averse. They like managing risk. So they want to dip their toes in first, understand, especially on the traditional side. I guess we're a bit more we're in the weeds on the crypto side, and we kind of know the details, and so we kind of know where we're willing to play, etc. The traditional industry is definitely getting there. It's improving, and I note that they also come a long way over the past year, and they will come along further. But they've got to start somewhere, and getting them to start somewhere and get they got to go up the approval chain within their organizations to make it happen, and they got to start small to get the approvals. And so you start here, you get some good experience on the board, and then things can change and improve and go from there. So I think this is a really good start, and I think the industry will come along and support it. It'll just may take a year or two to improve. So yeah.
And one of the things I like, there's no concrete answer, but it's in that extreme loss scenario. If there more than 10% of the active set is affected, would there be a fork? Like will there be a rally around pretending this never happened? You roll back the network before the double sign slashing event, especially if you think 10% of the active sets affected, all those affected are going to lose more than 30% of their staked ETH. So that's kind of what I think about. Like when I think about how could the Ethereum network improve? Arguably, there's benefits to something like the Polkadot model, which is like there's going to be a double sign event, but there's an evaluation of like, was it an actual attack on the network? Was it an accident? Like what was the root cause? The way Ethereum works is that there's no judgment involved. It's like you did it, it's considered an attack on the network, and you're slashed all the same, just the same as if someone was purposely attacking the network. So I do find, I don't know what you think, Hugh, but I do find the penalties on ETH quite significant. If anything, it seems a little too aggressive, especially now that it's super costly to try to attack, try to take over the network, to attack the network. I don't think one ETH loss really is necessary to dissuade people from an attack.
Yeah, they're definitely prioritizing security over anything else. And that's the position they want to do, and they want to be the most secure smart contract chain, etc. So it's playing entirely into that. And so to me, it sits right along what they're trying to do. I mean, obviously, comparatively, it is quite harsh, but they're really trying to put security first. And so I mean, that's where it's coming from. Would there be a fork? I have no idea. I do love the conversation though. I think it's a really interesting point to talk about. But no one actually knows until you get into that situation. I mean, but to me, if there is a client level bug in, like, I don't know, 2 major clients or something, and you're slashing 20, 30, 40% of the network, then there's definitely going to be a good conversation about it at a minimum. So I think there's no way you should rely on that, and from a delegator or a staker point of view, but it is something that could happen.
Yeah, and arguably over time, you'd expect there to be kind of a more averaging out of the validator clients being used. Like now, there's still a concentration in a couple, but especially once distributed validator technology, all like different innovations kind of in the pipeline come to fruition, you're going to see more diverse infrastructure being deployed. So you'll further reduce kind of that aggregation risk that exists now because of the concentration of clients being used.
Yeah, I think that's actually a really good point to follow up on this whole DVT technology, like distributed validator technology. Like one of the key risks that exists is like there being a client level bug with everyone running that client just accidentally or slashes at the same time, and you end up in this correlated scenario. But there's technology solutions that are rolling out now, some are being used already, that are like just specifically designed to prevent that risk or lower that risk materially. And so, while the system rules on Ethereum rules are what they are, it's probably not going to change anytime soon. There are solid technical solutions to deal with these types of risks coming up, and so that's probably going to help. One, on the pricing side, if we can get insurance, etc., but also it just like prevention is so much better than cure. Like, you never want your insurance policy to pay out. You want to do everything possible to prevent the thing happening in the first place. And so that's where the ecosystem is. There's a lot of money at stake at the moment, and there's a lot of really solid solutions being developed. So, and I only see that improving over the next couple of years.
Yeah, we'd love to see it with risk reducing, then the exposure to loss reduces, and then you're getting closer and closer to that uncorrelated scenario being the really truly the only thing you need to think about. I am curious too, if a customer is looking to get more than that 1 ETH of coverage, should they reach out and talk to the Nexus Mutual team? Maybe they can get kind of like a one-off additional cover.
Yeah, no, we're more than happy to support that. Like, we've got the 1 ETH one there. Like, you can grab that if as and when you want it. But if you want more coverage on Figment, then we're more than happy to work with you to get that up and running. It's not too hard for us. Most people wanted the 1 ETH from what we've been talking about so far, so that's where we started. But like, it's very easy to add something else if you're after that.
Yeah, I agree. You don't want to overcomplicate things and make people buy too much coverage at the same time. It's really, a lot of this has to do with education, like what we're doing today, and showing what the history of loss looks like. I spend a lot of my time at Figment with customers, walking them through some of the dashboards, the theoretical loss, but also actuals. And generally, the consensus walking away is, okay, I'm going to focus on that 1.07 ETH of uncorrelated loss. So yeah, but it is good that they have some flexibility if they want to reach out to you. There are some customers or folks that are attending this call that I'm sure are interested in other blockchain-y activities outside of staking. I am curious, does Nexus Mutual offer other types of policies that customers can look into outside of staking?
Yeah, we do. We so major stuff is like protocol cover or smart contract coverage for depositing into like DeFi protocols or something like that. So if you're putting money in like Aave or Compound or Curve or something like that. So it's kind of been where we've got a lot of the coverage. We're also opening up and some lines for like directors and office liability coverage for people operating in the space, running businesses, etc. And also we're recently looking at some crime policies as well, so cybercrime for like custodians or people custodying funds with others. So we're looking, we're providing a lot of different coverage options to a lot of the different sectors of the crypto space. And if there's something specifically that you need, then we're more than happy to have a look at it.
One of my favorite questions to kind of close on is, if you had a magic wand, what's the one thing you would change about Ethereum right now? Let's start with you.
UX. I just think the whole wallet thing is really hard. Like, whenever, like, I'm so used to it now because I've been in it for so long, but whenever someone new comes and they want to interact, and you're like, oh, you just do this, this, and this, you forget that, but it's just a pain. Like, it's like not intuitive because it's different to what everyone's used to. And so, like, I'm sure we will solve that, but if we can solve that, and that's probably not just an Ethereum thing, it's probably a wider crypto thing. But to me, if we can work that one out, I think that would take the space forward a long way.
I mean, mass adoption is definitely the most important problem that we need to solve here. But focusing on the staking, like on the risk side of things, if there was a magic wand for to be able to see on chain what the intent of someone was in the case of a double sign, I think that for me would be the thing that would be great to factor in, because at the end of the day, if you accidentally double sign, you're making it a little harder to achieve consensus briefly. It's not really a huge deal for the network generally, especially if it's not a very large percentage of the validators having the same issue. So ultimately, if there's a way of seeing, hey, this was just an honest accident, therefore either the penalty is very small or no penalty at all, I think that'd be a win, as opposed to just everything being more significantly affected in the case of a double sign event. I am curious, one last question. I know you said you want to wrap up, Chris, but I have a question around like on-chain cover when it comes to like the being regulated and falling under the insurance umbrella, or being rated like some of the other, you could have a AA, AAA rating as an insurance company. Is there a future that you see where on-chain cover will fall, will be able to say that this is regulated, truly insurance, even fall under like the rating umbrella, etc.?
I hope so in the future. I think we're a little way away from that, given that insurance is pretty slow industry to develop anyway, and the regulators in insurance are even slower than that, and that's who you basically have to convince. But I think like our aim is to be like address the principles of regulation and why you regulate even better than the current insurance companies. Like you regulate because someone else has control of the money or they could do the wrong thing. But here we've got automated code governing everything. It's all transparent. No one has access to the funds directly, so they can't run off with the money. And there's all that kind of agency of risk is kind of taken away. And one of the main reasons why you regulate is all that type of stuff. So, so what we're really aiming to do is prove that you can achieve the objectives of regulation in a different and actually far improved way. And then transparency is like a really key component of that. So, I see it happening in the future. Like we've been talking to regulators for a while, and they're definitely keeping an eye on it. They're not anywhere near actually accepting it yet as true regulated insurance, that's for sure. But I think the conversations are positive, and I think it will happen at some point.
And as we close out, how do the people get a hold of you, Hugh?
Yeah, I mean, just come and jump on our website, nexusmutual.io. There's a contact form there. I'm available on Twitter or on Telegram or whatever particular messaging app you use. I've probably got every single one of them at this point. But you can pretty easily find us or the BD team, bd@nexusmutual.io by email. So there's multiple ways. Go to the website, reach out. We're there.
Awesome. And Josh, how do the people get a hold of you?
Yeah, just put it in the chat. So Josh Fair, it's spelled F-A-I-E-R, at figment.io is my email. Happy to discuss anything that has to do with risk, coverage, insurance related to any network, not just Ethereum. It's my bread and butter. My Twitter handle is @fairplay. And then if you are interested in staking, more so not just talking about coverage and risk, but you want to talk about staking with Figment, you can reach out to staking@figment.io.
Awesome. And again, guys, you can use the same link you joined the call with to watch a replay. And Hugh has dropped his contact info in the chat as well. And with that, thank you guys for coming. And until next time, happy staking.
Thanks, everyone.
It's a pleasure. Thanks, Hugh.